Welcome to question 4 of Accounting Paper 1, November 2022. November 2020. Welcome to November 2020, Paper 1. Today we're going to be doing question 4, Corporate Governance, which is for 15 marks and 10 minutes. Shareholders and employees associated with the company will be particularly interested in whether the company is well governed and managed by the directors. At the AGM, the shareholders will elect two types of directors. Executive directors. They attend board meetings and work at the company on a full-time basis. Non-executive directors. They attend board meetings and do not work at the company. You are provided with 4 aspects of corporate governance that will be of concern to stakeholders. Required. 4.1 Audit Report. Explain why qualified audit report is not a good reflection of a company. Provide 2 points. A qualified report is an audit report that provides a negative opinion on the financial statements, whereas what you would like to see is an unqualified report. A qualified report may state that there was maybe not enough evidence in order to audit significant items in the financial statements, for example, revenue. Or it may be that there are some missing or incomplete information in the financial statements. Alternatively, that the internal controls that were assessed while doing the audit were insufficient. And what happens is a qualified audit report will discourage new shareholders from buying the shares and may even encourage existing shareholders to sell the shares, which will drop the share price as a result of the bad reputation now attached to the company. So all of those are potential answers that you could provide for 4.1. 4.2, the Board of Directors. Explain why it's important for a company to include non-executive as well as executive directors on the Board of Directors. So let's tackle executive directors. Now, executive directors, you'd usually find that being your CEO or your CFO. That would be sitting there as the executive directors on the Board of Directors. Now, why it's important to have them is because they have understanding of the day-to-day operations of the company and will provide you an in-depth insight into the operations of the company. Why is it important for non-executives to be in the Board of Directors? Well, they are independent and biased. Executive directors are not independent and biased because they earn a salary. So executive directors, while they provide you insight on the day-to-day operations of the company, their opinions and views may be narrow. Whereas non-executives, who firstly are unbiased and independent and will work in the best interest of the company, they will have a broader interest or broader views about the industry. Because generally they are experts in aspects of the industry that are required that are brought onto the board. Non-executives may earn less than your executive directors, but having more executives, be it executive or non-executive directors, having more directors on the board is a good thing, because the more you have, the more different opinions you have in making key decisions for the business. So those are potential answers you could put for the Board of Directors 4.2. 4.3, the Remuneration Committee. So according to the Companies Act 2008, a company must have a Remunerations Committee. Explain the role, responsibility of this committee and give a reason why this committee is necessary. So this committee is elected by the Board of Directors. In the committee, you have a chairperson and other members of the Remuneration Committee. So why do you have this committee? Well, the Remuneration Committee basically reviews your salaries, any other remunerations you may receive, like bonuses. And they also will propose to the board for approval, say next year's budgeted remuneration increases or bonus that should be paid to employees. They also prevent management from choosing to just pay themselves excessively. So how do they do that? Well, they help to benchmark and compare the employees in their company salaries to other competitors in the industry. They will provide for transparency, and they will be able to assist in avoiding any fraudulent activities and overstating salaries for certain employees. 4.4. Directors engage with clients on a regular basis in an effort to negotiate contracts and to increase sales and services. Explain why there should be a company policy that directors must declare to board all gifts, donations, or favors received by them from clients. Well, a gifts declaration is a mandatory aspect in very big and multiple companies. It's to avoid a conflict of interest. It may say that you may favor recommending certain products or providers to clients because you may get gifts. That would be one way. The other way, well, in this scenario, is where you're receiving gifts from clients, not from maybe product supplies, etc., that you may recommend to clients. Here you're getting from the client's gifts. So what will happen is you may have a conflict in interest in that you may want to service some clients that you get gifts from with more expensive or grand gifts better than other clients, and you don't treat them all fairly. By having this policy in place, it ensures that directors know what to do when they face the conflict of interest. Remember, if it involves family and friends, then it could even be nepotism. To protect the image of the company, it's important to have this declaration done. So those are relevant points that you can raise in order to get your 4 marks. Remember, to get 2 points, 4 marks, you name the point and then you discuss it a bit in order to get 2 marks for 1 point. And therefore 2 points will give you 4 marks.